Hey, it's Darius, and I'm on the CPA exam Facebook groups every day. And I love reading about when you pass and thank me for I-75. But what do you think's the most common question I answer every day? Which discipline should I take? And here's the answer. If you already passed reg and you enjoy entity tax, especially tax planning for entities, choose TCP. If not, but you already passed FAR and you like random calculations and formulas, then choose BAR, Business Analysis and Reporting. Otherwise, choose ISC, Information Systems and Controls. No calculations at all. Either way, I-75 will have you prepared for all parts of the CPA exam. Just go to i75cpareview.com. We always have a special, so go to i75cpareview.com. Get yourself on the right road with me, Darius Clark, because the right teacher makes all the difference. All right, what do we have to know about write-offs of accounts receivable? So when a receivable is formally determined to be uncollectible, the following entry is made. Let's assume an $800 receivable is deemed worthless. So you would debit allowance for credit losses and credit accounts receivable. Notice that they're both balance sheet accounts, so this write-off has no income statement impact. Because we've estimated for credit losses at year end, we've already taken care of the income statement. So when there is a write-off for a worthless receivable, it's all balance sheet. No impact on the income statement. And there's no impact on total current assets either. Both the asset, accounts receivable, and the contra asset, allowance for credit losses, are both decreasing by the same amount. In this case, $800. So the current asset accounts receivable is going down by $800. The contra asset, allowance for credit losses, is going down by $800. So since they're both decreasing by the same amount, there's no impact on total current assets. And that's what I can see them asking you on the exam. What's the impact on certain accounts for a write-off of a worthless receivable? Let's try this. Baker Corp uses the allowance method of accounts receivable. After recording the estimate for credit loss expense in the current year, Baker Corp decided to write off the $130,000 account of a customer who had filed for bankruptcy. What effect does this write-off have on Baker Corp? So what do we say the journal entry is for a write-off? Debit the allowance and credit accounts receivable. A write-off is reducing the allowance and it's reducing accounts receivable by the same amount. And it's all balance sheet, right? Because accounts receivable is a balance sheet account, current asset, and the allowance is also a balance sheet account, contra asset. So there's no impact on the income statement. So A says net income decreases, that has to be wrong. B says net income increases, that can't be right either. C says net income decreases, so A, B, and C have to be wrong. The answer has to be D. Total current assets do not change, net income does not change. So D is correct. When Baker Corp writes off the $130,000 account, it reduces accounts receivable and reduces allowance for credit losses by the same amount. Write-offs do not affect total current assets because the reduction in accounts receivable is offset by an equal reduction in the contra asset, the allowance account. And that's all balance sheet. Net income does not change because the expense is not recognized now. It was recognized when the allowance for credit losses was initially recorded. The write-off is essentially a balance sheet adjustment. The write-off does not affect the income statement. What about this? What happens to the credit loss expense on the income statement when an account receivable is written off under the allowance method? Does the credit loss expense increase? No. Does it decrease? No. It remains unchanged. Letter C is correct. When an account receivable is written off under the allowance method, the credit loss expense on the income statement remains unchanged. The credit loss expense has already been recognized in the period the expense was estimated, and the allowance was increased for that estimate. So the write-off is simply a realization of the previous estimate, and the write-off affects only the balance sheet accounts, specifically the accounts receivable and the allowance for credit losses. There is no additional expense recorded on the income statement at the time of the write-off, and you're going to need to know that for the exam. Letter C is correct. So let's review what we know about a write-off. Before the write-off, accounts receivable, let's say, is $150,000, and the allowance for credit losses is $50,000. That makes the net realizable value of accounts receivable $100,000. You should know that accounts receivable minus the allowance is the net realizable value. And if the net realizable value is $100,000, let's assume $10,000 of AR is written off. So we'll reduce the allowance, we'll reduce accounts receivable. After the write-off, accounts receivable has gone down by $10,000 from $150,000 to $140,000, and the allowance has gone down by $10,000 from $50,000 to $40,000. So what's the net realizable value after the write-off? It's still $100,000. It's $140,000 of accounts receivable minus the allowance of $40,000. NRV doesn't change because of a write-off. Why did NRV stay the same? Because the accounts receivable went down by $10,000 and so did the allowance. So the two components of NRV, they changed. They both went down by $10,000, but the total net realizable value of accounts receivable stay at $100,000. So before and after a write-off, NRV doesn't change, and you'll need to know that for the exam. What about recovery, though, of amounts previously written off? What's better than going to the mailbox and getting a good surprise? So that customer who you wrote off, all of a sudden, the bankruptcy trustee found some money and sent your business a check. That's great news. That's cash where you never expected it. But how do you account for it? How do you account for amounts that were previously written off and now you've recovered it? We wrote off $10,000. Let's recover $4,000 of the 10. So now you'd have an entry of increasing accounts receivable by $4,000 and increasing the allowance by $4,000, and at the same time increasing cash by $4,000 and reducing accounts receivable by $4,000. Notice what happens to accounts receivable with these two entries. First it goes up, but then it goes down by the same amount, canceling out the impact on accounts receivable. So there was no impact on accounts receivable for this recovery because it went up by $4,000 and simultaneously down by $4,000. So all we're left with is an increase in cash of $4,000 and an increase in the allowance for $4,000. So what happens to NRV, net realizable value? Accounts receivable, $140,000, both before and after the recovery, because we said the net impact on accounts receivable for this recovery was no impact. So accounts receivable is still $140,000, and then due to the recovery, the allowance has gone up by $4,000 from $40,000 to $44,000. So the allowance is $44,000, accounts receivable is $140,000. So what's our NRV after recovery? $140,000 minus $44,000. NRV is now down to $96,000 as a result of recovering the $4,000 in cash. So although the accounts receivable itself didn't change, the NRV dropped from $100,000 to $96,000. NRV after the write-off but before the recovery was $140,000 minus $40,000, or a total of $100,000. But after the recovery, NRV is now down from $100,000 to $96,000 because the $4,000 that was recovered increases the allowance. And when the allowance goes up, that's the contra asset, the asset goes down. So the NRV is down to $96,000, but the accounts receivable is still $140,000. Why did the NRV go down and the accounts receivable stay the same? Because the allowance went up. The allowance went up from $40,000 to $44,000 when we recovered the $4,000. So the exam will probably ask you, what's the impact on these accounts for a recovery of amounts previously written off? And you'd say cash up by $4,000, allowance up by $4,000, which means total current assets are still $100,000. Total current assets haven't changed. We have $96,000 of net realizable value of accounts receivable. That's a current asset, plus $4,000 of cash. So total current assets, no change. So recovery has no effect on total current assets, no effect on total assets, no effect on net income. But recovery does reduce NRV and recovery does increase cash. And that's what the company wants. They want to turn their receivables into cash. So by recovering $4,000, that helps with that. It helps you collect more cash and reduce net realizable value of accounts receivable. Notice that these two entries that we made for recovery is all balance sheet. no income statement impact for a recovery, just like there was no income statement impact for a write-off. All right, how about this question? Net realizable value of accounts receivable is defined as accounts receivable minus the allowance for credit losses. Net realizable value is not impacted by which of the following? And if you think you know, leave me the answer in the comments section. And remember to like and subscribe because it helps the channel out a lot. And if you need more help with receivables or any part of the CPA or CMA exams, go to i75cpareview.com. Get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference.